Welcome back to Squawk Box this morning, right here on CNBC. Rick Santelli standing by at the CME in Chicago. Got some new inflation data. Rick, the numbers, sir.
Yes. Yeah, the personal income and spending for the month of December. And of course, we all understand that some of the Fed's favorite metrics regarding pricing are embedded in this report. Let's start out with the headline, shall we? Personal income expecting to rise by 0.2%, delivered exactly 0.2%. But do keep in mind, in October it was up 0.7, so 0.2 is a great number, but it's still the lightest number since January of 22 when it was minus 0.1. Now, if we look at the spending side, also exactly as expected, which was minus 0.2%. Minus 0.2% is the lightest number. It equals December of 21. You have to go all the way back to February of 21 to find a bigger negative number. That isn't good. And if we look at real spending, of course, it adjusts for inflation, it's down 0.3. Here we go into the money numbers. Personal consumption expenditure deflator month over month is up 0.1%, and that's about what we were expecting, and arguably you could say it's a little hotter. We're expecting unchanged. It equals the rear view mirror. The last time we had a lower number was down 0.1, but that was already in July, and in between then and now we were up 0.4 last month, but that was revised, so only up 0.1. And now we look at the big year-over-year number, 5%. The deflator year-over-year is 5% as expected, and this is good news. 5.5 in the rearview mirror. To find a number on a percentage change year-over-year smaller than 5%, you're going all the way back to September of 21. That's very good news. On the core deflator month-over-month, 0.3, exactly as expected. We're following a 0.2 number. The high water mark there was all the way back in April of 21 when it was up 0.6. So we've made some real progress there. And the last, maybe the most important, personal consumption core deflator year-over-year delivers at 4.4%, which was expectations exactly. In the rearview mirror, it was 4.7. The high water mark there was 5.4% in February of 22. The last time we had a number that was smaller than 4.4%, you have to go back to October of 21. Now, let the markets speak for themselves, Andrew. If you put up a 10-year note yield chart, we were at 354 before the data. We're at 353 now. Big whoops, right? 1 basis point. But 1 basis point here is very important. It gives us a notion that the market isn't nervous about this number in any way. We can always see inflation lower. It's still too high historically, but we've made significant progress, and that's what the market's going to pay attention to. Back to you.
Rick, thank you very much. I want to get over to Steve Liesman, who joins us now with more. He's been looking at those numbers. What do you think?
I think they're pretty good numbers, Andrew. I'm looking at the inflation data inside, and what I see is a 0.7% decline on goods inflation. However, the unfortunate part is the thing that Powell looks at, or at least a proxy for it, because we can't calculate it right away, which is services inflation was still up 0.5 compared to 0.3% in the prior month. Core inflation, Rick, is right up 0.3%. Look, income is doing okay, up 0.2, and it's the spending. We had a contest here, Andrew. We had a split decision between a strong October and a lousy November, and December wasn't much better, so that kind of confirms what I wanted to see was the impact on services versus goods spending overall. It's going to take me 1 second to look at that, but that's been an issue, whether or not this decline in goods spending has shown up in the service sector. And I've got to run the table, which table is it? Table 6 here, or table 7 to look at it. Yeah, service inflation it looks about flat, actually. Sorry, service spending looks about flat this month. I'll come back to that, Andrew, but the key here is the extent to which service consumption has taken the place of goods for consumers. We'll see, Andrew, you did have something of a rebound in the savings rate. So you had a big decline in the rate of savings. People had a lot of money stocked up. Now it looks like, and they drove that down. Now it's like they're building it back up. That's going to be a key, I think, to getting to a more stable economic footing here, was getting that savings rate back up to a better place.
Very good. Steve, thank you for that analysis, of course. Have a great weekend, my friend.
And coming up, maybe touch on all these things. Former Dallas Fed President Richard Fisher helps us break down PCE inflation data and the Fed's next move. Stay tuned. You're watching Squawk Box on CNBC.
Conventional thinking delivers conventional results. At Allspring, we break away with purpose, harnessing data-driven insights and boundless curiosity. We dissect the market from every angle, helping to build portfolios that redefine what's possible.